Imagine a line, just one simple line that can tell you where prices are going next. A line that could help you spot big moves before they even happen. A line that could turn confusion into clarity and your guesses into smart decisions, guys. That is the power of Trendline. Today, I am going to discuss what a trend line is, types of trend lines, how to draw them. I'll also show you the two most commonly used trend line trading strategy, which are the trend line bounce strategy and then the trend line breakout strategy, of course. Finally, I'll show you how to avoid fakeouts when using trend lines to trade. Ladies and gentlemen, welcome to Cash Course Plus. Welcome back, guys. Now, first things first, what is a trend line? A trend line is simply a straight line you draw on a price chart to show if the price is going up, coming down, or going sideways. Let me repeat it. A trend line is simply a straight line that you draw on a price chart to show if the price is going up, or coming down, or going sideways. Now, this trend line helps to spot trends and predict where the price might go next. So when I say it helps to spot trends, right, some people might say, what is this trend we are talking about? So trend simply means a direction where price is moving. Okay, as you can see on the screen now, this is an uptrend, right? So the trend line helps to spot trend. If the price is going down, then we call it a downtrend. And if the price is choppy, maybe in a choppy market, something like this, we say it's a sideways trend. That's just what it implies right here. Now, when the market is going down, it becomes a downtrend, and when the market is going sideways, it becomes a sideways trend, like we've discussed. Now, moving on to the next topic is how to correctly draw a trend line. So drawing a trend line is super simple, guys. It is super simple, right? All you have to do is to connect key lows on an uptrend. So when you hear key lows, let me show you what I mean. So on the uptrend, if you have been following, or if you're good with your higher highs and higher lows concept, you know that if the market is going on an uptrend, it forms something like this, right? It gives this staircase-like structure. The pointy V at the bottom of an uptrend is called higher lows. It's called higher lows. It's called higher lows because whenever price gets to this level, okay, it gets higher and then forms another higher low, higher than this previous level. So the market keeps making the price to actually form higher lows. As buyers are stepping in, the price keeps forming higher lows. So on an uptrend, you'll tend to draw the trend line on the higher lows. So if on an uptrend, or if you notice that the chart is going on an uptrend, all you have to do is to connect these higher lows with a line. Now this line is what we call the trend line. This is simply what we did right here. Okay, now this green line is the line that is connecting these higher lows that the market is forming, right? That is how you draw a trend line on an uptrend. Now let's go to a downtrend example and see. So guys, for a downtrend, find at least two lower highs. Remember, on an uptrend, we were looking for higher lows. Now, on a downtrend, we are going to look for lower highs. What it means is that on a downtrend, the market tends to form structures like this, right? Like a down staircase structure. And these are the lower highs. This tip of the price are the lower highs. It means that this high right here, let me show you something. This high right here is lower than the previous high. So also this high is lower than this previous high, and then this high right here is also lower than this previous high. That is just how lower highs are being formed. So if you observe something, you're going to see that on an uptrend, we drew the trend line below the below the chart, right? We drew the trend line below the chart, but on a downtrend, we are going to draw the trend line above the chart. So let's get back to the example. So as you can see, the trend line is above the chart on the downtrend, while on an uptrend, the trend line is going to be below the chart. And remember that the more touches you get, the more stronger and reliable the trend is. What I mean by the more touches you get is that if you want to draw a trend line, make sure that it has at least 3 or to some extent, some people use 2, as low as 2, but make sure it has at least 2, 3, 4, and above places where the price touched the trend line. As you can see over here, there's touch point A and touch point B. This makes this trend line a valid trend line. All right, this makes this trend line a valid trend line. Now let's see an example of a sideways trend line. So guys, for a sideways trend, the case is a bit different. So you find equal point at the top and at the bottom where price hits and bounce back several times. Then you connect the points just as we did right here. Okay, you connect the points, and this is your sideways trend line. Okay, so these lines, these green lines, are the support and the resistance. So on an uptrend, when the market, let me clear this. Okay, so on an uptrend where the market is making higher highs and higher lows, the trend line is at the bottom of the line connecting the points, right? It's at the bottom of the chart connecting the point. So it's serving as a support to the line. Then on a downtrend, okay, on a downtrend like this, okay, the trend line is at the top of the chart, serving as resistance to the price. The price keeps bouncing back when it hits the line, when it hits the price. Okay, now step number 2, let's get to the rules governing a trend line. You can't just draw a trend line and irregularly and expect it to just respect the price, or expect price to respect the line all the time. So there are rules governing those trend lines. One has to follow these rules in order to have perfect and clear understanding in what is currently happening in the market. Now, the first rule in trading trend line is to never force the line to meet each other. All right, never force the line to meet each and every point, because if the line doesn't fit or match the point, simply ignore the point. That is, like, should I say, it's an invalid trend line. It has to meet at least 2 or 3 points. But if it doesn't meet, or if price doesn't touch the trend line, don't force the line to actually get into the price and touch it. Okay, let me give you an example. So guys, if you notice clearly on your screen, you're going to see that the trend line started right here. But just because it started right here and then formed another higher low over here doesn't mean that the trend line, which is this green line, has to meet the price over here. As you can see, this place we are talking about did not actually touch the trend line. We just waited. Also, this place right here did not touch the trend line. We shouldn't force the line, okay? We shouldn't force the line to actually touch this point where price didn't meet. All you have to do is to exercise a little bit of patience until the line, or until price naturally touches this line. That is when you consider your trend line a valid trend line, okay? So because we were patient enough, the price actually touched this line, okay? And then it wants to touch this line. So we are fine even if the price did not touch over this place. Our trend line is still valid because it has one touch point over here and another touch point over here. I hope you are understanding how the rules work, okay? Never force touch points to actually touch. Rule number 2 is always wait for a confirmation before trusting a trend line. Always wait for at least 2 to 3 bounces before trading it, okay? So if I want to trade this trend line over here, all right, I won't just get off of I won't just get on this trade simply because it has one higher low over here and another higher low over here and another one over here. This is a sign that the market is actually going down, but I have to wait for the price to actually touch another point on the line. Only then can I consider to actually enter a short position, then drive this trade right down, go back up, and then keep driving it downwards if that's if a breakout doesn't actually happen. Okay, so always wait for confirmation. Always wait for at least 2 or 3 bounces before entering a trade using trend line trading strategy. Okay, now rule number 3 is some traders do ignore wicks. What I mean by some traders do ignore wicks is that you hear some traders saying ignore wicks and focus on price. Okay, so what it means is that some traders only focus on the candle body. I hope we all know what a body and a wick is. We all know the difference between the body and the wick. The wick are this, this fingerprints. Okay, let me show you. The wicks are this footprints. Sorry, this thin lines that are being left by the candlestick. It's just an indication to tell you that price was once at that level before it actually went down. So some traders don't consider wicks to be an indication that the trend line is actually valid or not. But overall, I do trade wicks. Okay, I do. If a wick touches the trend line, I also consider it as a valid touch point. Okay, so that's just what it means. These are the 3 rules. As you can see over here, we actually got a body touch. Okay, not a wick touch, because the trend line actually is resting on the body of the candlestick. Okay, that's just what it means. Okay, now we are going to talk about the two most commonly used trendline trading strategy. Okay, we commonly have two popular trendline trading strategies, which are the bounce trading strategy and the breakout trading strategy. So guys, let's begin with the trendline bounce strategy. So as the name implies, trendline bounce strategy means that the price bounces back to the trend line, to the direction it was going after it touches the trend line. Okay, trendline bounce strategy means that if the price goes up, it comes back to bounce, hit the trend line, and then continue in the direction that is actually going, or it's actually heading, right? So the next question you will want to ask is, how can we trade a trend line bounce strategy? So for example, if the market is on an uptrend, which it is now, okay, all you have to do is to draw the line, which is this line over here, right? So after drawing this line, you wait for price to bounce back, okay, and touch the trend line, and if it bounces, you then trade in the trade direction. Okay, so after this bounce right here, that is where your entry is going to be. But before entering the charts or before entering the market, there are things that you need to consider, because you might want to ask, how can we tell if the price is going to bounce back or if it will actually break out? This is a question that is very, very, very important. You have to know, you have to confirm that this price wants to keep going up, or the price wants to actually go down and change the market structure shifts. Okay, so there are two ways to know that the price wants to actually go back up or the price wants to break out. The first way is to wait for a bullish reversal candlestick pattern, maybe like the bullish engulfing, or a very strong candle, a very strong high thick green candle, okay, to the upside, or the maybe bullish pyramid, the hammer, or the pin bar, the doji. They are all bullish confirmation candlesticks. Now the second way to confirm if the bounce will be valid is to use technical analysis indicators like the volume indicator or the MACD signal shift indicator. Personally, I prefer to use the MACD indicator because it gives me a precise and detailed information on whether the price will break out or not, and it also gives me information on the strength and momentum of the bounce. But however, I'll show you how to use the volume indicator on this video. I'm going to show you how to use the volume indicator on the bounce strategy and the breakout confirmation strategy, but time will not allow us to explain how to use the MACD indicator. So in order to learn how to combine the MACD indicator, which I believe is more effective, with your trend line strategy, you can contact us using the WhatsApp link on the description below to enroll in our mastery class, of course. Now back to the topic. To confirm if the price wants to actually bounce off from the trend line, all you have to do is to turn on the volume indicator, which we actually have done so. So this is our volume indicator right here. All right, this is our volume indicator. After turning this volume indicator on, the next thing you have to do on an uptrend, you just wait. If the price reaches the trend line, just like it did right here, okay, so if the price reaches the trend line, then it means that buyers are going to become strong. But how can we tell if the buyers are going to actually get strong? All we have to do is to wait, okay? All we have to do is to wait for another candlestick to print to see if it's going to be a strong green candle or maybe a hammer candle, indicating, as you can see, there's a pin bar, okay? This green candle over here is called a pin bar, the green candle that just printed. But let's wait for a confirmation candle to actually see if the price is actually going to go up or not, okay? So let's just wait and see. Now we have confirmed that the price actually wants to go up, because this price or this candle right here is a very big green candle. It's a full candle, indicating that the price wants to continue to its actual direction. So we should consider entering at this level. Now let's enter to see how things go. So guys, I am just going to enter this trade right here, and then I am going to place my stop loss just over here. I'll tell you why I'm placing my stop loss at this level, and then my take profit at this level. So the reason why I place my stop loss at this level is because most traders sometimes think that the moment the price breaks below this line, then that is it. They are just going for a short position. No, we are still on an uptrend, guys. Don't make the trend line always predict or always govern or tell you what to do all the time. The trend line is there to show you the direction of the trend, not the market structure shift, not change in the character of the market, okay? So even if price breaks through, as long as the trend line, or as long as the price has not gotten to this previous low, then you are still on an uptrend. This is important, guys. A lot of traders don't know about this. The moment the price breaks through, they'll just place a short position and then find out that it's just a fake out, okay? So until price breaks below this, that is when you are going to be looking for shorts, and you can't just enter at the breakage of this. You have to make sure that the price goes back to retest this place right here, if the price retests and then comes back down, you have 2 touch points. Only then can you be able to start thinking about entering. Okay, when price goes down, you can then enter at this level and then expect price to go back down. I hope you are understanding what we are doing right here. Now let's see how this is going to play out. So we are on. Now let's see. Perfect. We just took profits over here. Have you seen how easy this is? You know, the problem is not about knowing how to trade it. The problem is you, right? So trading is 90% knowing yourself and 10% knowing the market. Okay, if you have the ability to actually control your psychology, your emotion, being able to be patient, you know, you can be able to actually profit off of the market. Okay, so as you can see right here, when the green candle formed, a very huge green candle formed, green bar formed just below, okay, just below the volume area, indicating that buyers are coming in strong. Okay, so more green candle, less red candle. So if the red candle is declining while the green candle is inclining, it means that even though sellers are getting into the market, they are weak. Okay, as you can see, let me show you something. As you can see, the green candle is going up while the red candle is coming down. This means that buyers are stronger, sellers are getting weak. Okay, so this red pullback should not scare you, because the volume never lies. Okay, the volume tells you the amount of people or the amount of sellers that are getting into the market at a particular time and how strong they are in the market. Okay, that's just what it means. All right, so that is how you can be able to combine the volume indicator to actually trade this. Okay, now let's get to a bearish scenario and see how things go over there. So on a bearish scenario, if you notice quite well, you're going to see that if you look at the volume indicator, all right, you're going to see that there are more red candles and lesser green candles, and the red candles are actually, you know, longer than the green candles. The red candles are inclining while the green candles are declining. So this is a confirmation for you to know that the bears or the sellers are getting in stronger, and the buyers who are trying to, you know, actually maintain price are getting weaker. All right, so if you have your one touch point, your second touch point, all right, now we are looking for short positions, right? We are looking for short positions. So in order to do that, all we have to do is to wait for a confirmation after this second touch right here. After confirming these 2 touch points, right? After confirming this touch point and then this touch point, then on this second touch point, you are looking for a short position. A short position means that you are looking for sales, right? You are looking for sales. So all you have to do is to wait for confirmations, like maybe a strong bearish candle to the downside to actually show you that this market is actually going down. So now let's see how it plays off. Now we have our strong candle. Okay, we have our strong bearish candle. We can look to enter right here and see how things go. So our stop loss is going to be at this low right here, this pullback right here. Okay, this is where we are going to put our stop loss. Our stop loss is not going to be just after this candle. Maybe if price decide to break out of this candle, it can be a fake out on a higher time frame. Okay, it might just be a fake out and price might just decide to go back in. So until price breaks through this low right here, only then can we be able to see or to tell if the market wants to actually reverse to the upside or not. Okay, that is just how it works. Okay, so now let's go for a short position to see how it's going to play off. So guys, as you can see, our stop loss is placed just a little bit above the previous high. Okay, since we are going for a short position, we are not putting our stop loss on lows, we are putting our stop loss on previous highs, and our take profit is just 50% of the stop loss. Okay, it's a 1-to-1 risk reward ratio. Now let's see how this plays off. Okay, there's a very important thing I need to let you guys know. In trading, or should I say trading, is 90% waiting and 10% buying and selling. Okay, and do not let emotions and, you know, sadness or fear of the market going on an opposite direction to pull you out of the market, because people get manipulated by the market a lot of time because of their emotions. Okay, you just have to trust the process. If you trust your trading plan, you trust your A setup, you trust your strategy, then just let it outplay. Just let it all play. I'm not saying that there's no such thing as losses in the game of trading, but our wins should be more than our losses, right? So we are at profits. Let's see if we are going to actually take profit anytime soon. So guys, did you see how the market actually manipulated us, took us from this point right here, from this point right here where we entered the trade, down to this point where we exited the trade, and it's just, going up and down, playing with our hearts, playing with our blood pressure. That's just how the market actually does a thing. Okay, it makes you feel that you are going to get stopped out, but as long as you know what you're doing, and you know your A setup, right, you are going to have more profit than losses at the end of the trading session. Okay, so we just took profit right here, okay, and we are out of the trade. So you just have to learn to exercise patience, wait for the trade to actually get into your profit zone. Okay, so let's get on to the next strategy, which is the trendline breakout strategy. The trendline breakout strategy occurs when the price breaks either above or below the trend line, if you're either in a bearish or a bullish situation. Okay, now how can we trade the trend line breakout strategy? So as usual, okay, you draw a trend line. Let me show you what I'm talking about. So guys, when trading a breakout strategy, as you can see, we have our first touch point and we have our second touch point, and this touch point right here actually broke out. But simply because the point broke out does not mean that a change of character has occurred or a market structure shift has occurred. It doesn't mean that from now henceforth the trade wants to actually go back up. We have to see other things. There are other things that we have to put into consideration, like the volume indicator, right? The volume indicator, the rising and falling of the volume bars, and last but not the least, the previous high. As you can see, this is the previous high, so we have to make sure that this price right here, okay, is above this previous price. Okay, only then can we be able to tell if the market wants to actually go back up or not. Okay, so as you can see, let's see something. I think the price is currently above the previous high right here. Yeah, the price is currently above the previous high by a little bit. Okay, by a little bit. You can consider to wait for another additional candlestick pattern to form, all right, to see if the market will actually continue going up or not. And this is our previous low. Okay, so if you are to enter this trade, this point is where your stop loss is going to be, and you're going to start over here, and your target should be somewhere around here where the first touch points actually started. Now let's enter this trade to see if our analysis is actually going to give us what we want. Okay, so guys, we are going to place our stop loss just a little bit below the previous low, all right, and then put our take profit equal to our stop loss, because I like using the 1-to-1 risk reward ratio. It works for me almost all the time. Okay, now let's see how this trade plays out. Whoa, so there's a drawdown, but we're still in the game. We're just going to see how well it plays. As you can see, we're in profit. And we have took profits over here, guys. We just took profit over here. Now this is how to trade the breakout strategy. This video is getting longer and I don't want that, so if you know how we did on this bearish market, you can be able to use this to actually do this on the bullish market. Okay, so that's just how this is. And we have also talked about how to avoid fake outs. Okay, when you're trading the breakout strategy, you have to wait for the market to disrespect the previous high if you're looking to go bullish, or disrespect the previous low, go lower than the previous low if you are looking to go bearish. Okay, so guys, if you notice on all my videos, I normally talk about how important it is for a trader to be patient, right? So trading is all about patience, waiting. As you know, it might get a little bit boring, but there's something that you guys need to know. Trading is not exciting. If you're still happy, if you're still excited because you're profiting in the market, then you are not yet a professional trader. Trading is boring as hell. Trading is very boring. Doing the same thing, the same routine over and over and over again. It's boring. What just makes it a little bit exciting is that your boredom pays you with actual dollars, right? So unlike real life, where you have to act the sooner you act, the sooner you execute, and the more profitable you become in whatever it is in real life. Trading, the more patient you get for your setup to just come to you, the more profitable you become in the long run. Okay, so it's all about patience, 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 right? You just have to make the market to align with your setups. Then you're always going to be at the winning end. I hope this video helps, and I hope you have a nice day.
The hard truth about trading, it's all about you. Self-awareness. Trading requires looking at and improving oneself. Patience. Success depends on the ability to wait for the right opportunities. Discipline. Consistent adherence to a trading plan is essential. Emotional control. The ability to stay calm and do nothing when needed is crucial. Personal responsibility. Trading outcomes depend more on the individual than external factors. Character development. Trading tests and reveals one's inner strength and resilience. Trust in data. Charts provide truth.